Warren Buffett is worth over $140 billion. But here's the secret nobody tells you. He didn't get rich by being a genius. He got rich by avoiding stupid mistakes. Warren Buffett said, there are two rules of investing. Rule number 1, don't lose money. Rule number 2, never forget rule number 1. Sounds simple, right? But most investors break these rules every single day. Today, I'm going to show you the 7 biggest investing mistakes Warren Buffett has warned about for decades. These are real mistakes that destroy real money, made by real people. And here's why this matters right now. Buffett is 94 years old at the 2025 annual meeting, his 60th and final year as CEO. He announced he's stepping down. 19,700 people showed up to hear him speak. That's a record. So, before the Oracle of Omaha leaves the stage forever, let's learn from the best. Let me also tell you what we're going to cover. First, the 7 mistakes. Then, I'll show you what Buffett does instead for each one. Then, a special bonus section on Buffett's current portfolio and what he's buying right now. And finally, 3 actionable steps you can take today. Let's start with mistake number 1, trying to predict the market. Here's what Buffett says about this. The stock market is a device for transferring money from the impatient to the patient. Think about that deeply. Every time you panic sell, a patient investor buys from you. Every time you FOMO buy at the top, a patient investor sells to you. Let me give you a shocking fact from the year 2002, the year 2020. If you missed just the 10 best trading days, your returns would have been cut in half. Not 10 years, 10 days. Let me repeat that, because it's so important. Missing just 10 days over 20 years cuts your returns in half. And here's the cruel joke. The best trading days almost always happen right after the worst trading days. So if you sell during a crash to wait for things to settle, you will almost certainly miss the recovery. Let me give you a real example. In March 2020, when COVID hit, the stock market crashed fast. Many investors panicked and sold everything. They said, I'll buy back when things look safer. But the market bottomed on March 23, 2020, and then it started climbing again, immediately. The people who sold missed the biggest rally in years. The S&P 500 went up almost 70% over the next 12 months. But the timers, they were sitting in cash, waiting for a pullback that never came. What does Buffett do instead? He buys great companies and holds them forever. In his 1988 letter to shareholders, he wrote, our favorite holding period is forever. Not 5 years, not 10 years. Forever. Buffett bought Coca-Cola in 1988 and still owns it today. He bought American Express in the 1960s and still owns it today. He bought Apple in 2016 and still owns it. Today, he doesn't sell because the news is scary, doesn't sell because the market drops. He holds that time in the market, beats timing the market every single time. Here's another way to think about it. Imagine you have a farm that produces corn every year. Would you sell your farm just because the price of corn dropped for 1 week? Of course not. You'd keep the farm because it produces value year after year. Stocks are the same. They are pieces of real businesses. If the business is good, short-term price drops don't matter. That's mistake number 1. Now, let's talk about a mistake that has destroyed even very smart investors. Mistake number 2 is borrowing money to invest. Wall Street calls this buy-in on margin. I call it playing with fire. Here's Buffett's take. If you're smart, you don't need borrowed money. If you're dumb, you shouldn't use it. Let me explain why this is so dangerous. When you invest your own cash, your stock can drop 50% and you're still in the game. You can wait. You can be patient. You can hold for 5 years until it recovers. But when you borrow money, your broker can sell your stocks without asking. This is called a margin call. And it always happens at the worst possible time, right when the market is crashing. Let me give you a real story. In 2008, during the financial crisis, many investors had borrowed money to buy stocks. When the market dropped 40%, their brokers called them and said, "You need to deposit more cash or we will sell your stocks." Most people didn't have extra cash, so the brokers sold everything at the absolute bottom of the market. Those investors lost everything and never recovered. But if they'd used their own cash, they could have just waited. By 2010, the market was back up. By 2030, it was at all-time highs. The borrowers were wiped out. The cash buyers got rich. Here's something most people don't know. Even Berkshire Hathaway, Buffett's own company, keeps over $30 billion in cash. They don't borrow. They don't use leverage. They don't need to. Buffett has said many times that leverage is the only way a smart investor can go broke. He said, "It is never obvious that you are over-leveraged until you are dot." At the 2025 annual meeting, Buffett talked about watching smart investors blow up because of borrowed money. He said leverage is the quickest way to go from rich to poor. He mentioned long-term capital management, a hedge fund run by two Nobel Prize winners. These were geniuses, PhDs, mathematicians. They borrowed huge amounts of money to make bets that seemed almost guaranteed to win. But in 1998, a small, unexpected event happened. And because they were they went from having billions to zero in just a few weeks. Nobel Prize winners wiped out because of borrowed money. Bottom line, never invest money you don't own. If you can't afford to buy a stock with cash, don't buy it. No exceptions. That's mistake number 2. Up next, why following the crowd is a recipe for disaster. Mistake number 3, following the crowd. You've heard this Buffett quote before. Be fearful when others are greedy. Be greedy when others are fearful. But actually doing it is incredibly hard. Because when everyone around you is getting rich, your brain screams at you to join in. That's called FOMO, fear of missing out. Let me tell you a story about the dot-com bubble in the late 1990s. Stocks of internet companies were going up like crazy. Companies with no profits, no revenue, sometimes no product were worth billions. Everyone was getting rich, your neighbor, your Baba, your cousin. And Buffett was sitting on the sidelines. People called him old-fashioned, out of touch, finished. A magazine even put him on the cover with the title, "What's wrong, Warren?" But Buffett didn't care. He said, "I don't understand these companies, so I won't buy them." Then came the year 2000. The bubble burst. Nearly all those internet stocks went to zero. People lost everything. And Buffett, he bought great companies like Coca-Cola and Wells Fargo when they were cheap. He made billions. Here's the problem. By the time your barber or your Uber driver or your cousin who knows nothing about stocks is giving you investing advice, the party is almost over. The smart money has already positioned itself, and they're looking for someone to sell to. Buffett has seen this cycle again and again. In the year 2000, it was dot-com stocks. 2021, it was meme stocks and crypto. Same pattern every time. The crowd rushes in at the top, panics at the bottom, and patient investors get rich. Let me give you a specific example. In June 2024, Buffett went on CNBC and called Bitcoin a gambling token with no intrinsic value. His partner Charlie Munger was even blunter. He said crypto investors are fools. Now, I'm not telling you whether crypto is good or bad, but here's Buffett's point. If you're buying something just because everyone else is buying it, and you don't actually understand what you own, you're not investing, you're gambling. There's a big difference. Investing is buying a piece of a business that produces value. Gambling is betting on a price going up so you can sell to someone else. Buffett calls this the greater fool theory. You buy something overpriced, hoping to find a greater fool to sell it to later. That works until it doesn't. And when it stops working, you're the fool holding the bag. Buffett's rule is simple. Buy when there's blood in the streets, buy when everyone is terrified, and when everyone is greedy. Just sit on your hands. In 2008, when the financial crisis was at its worst, banks were failing. People thought the world was ending. Buffett wrote an op-ed in the New York Times. He said, "Buy American, I am." And he did. He invested $5 billion in Goldman Sachs when everyone else was running away. That investment made him over $3 billion. He bought Bank of America stock when it was hated. That investment made him over $12 billion. While the crowd was panicking, Buffett was buying. That's mistake number 3. Now, let's talk about a mistake that sounds smart but isn't. Mistake number 4 is owning too many things you don't understand. Most financial advisors tell you to diversify, own 50 different stocks. Spread your risk. And for someone who doesn't want to think about investing, that's fine. But Buffett disagrees. Here is what he said. Diversification is protection against ignorance. If you know what you're doing, it makes no sense. Let me show you why. According to Berkshire Hathaway's official SEC filing, their portfolio is worth about $274 billion. And here's the crazy part. Over 70% of that money is in just 5 stocks: Apple, American Express, Bank of America, Coca-Cola, and Chevron. 5 companies, 70% of $274 billion. That's not diversification. That's concentration. Now, here's the key. Buffett only owns companies he understands completely. He calls this his circle of competence. In a 1999 annual meeting, he explained it like this. Different people understand different businesses. The important thing is to know which ones you understand and stay inside that circle. Let me give you an example of what this means. Buffett has never owned a tech stock like Google or Amazon for many years. Not because those are bad companies, they're great companies. But because he said, "I don't understand how they will look in 10 years. He stayed inside his circle. Later, he finally bought Apple, but only after he understood it as a consumer products company with loyal customers, not as a tech company. Here's a simple test for you. Can you explain how a company makes money in 2 sentences? If not, don't own it. Let me give you an example of a company inside most people's circle of competence. Coca-Cola. How does it make money? It sells syrup to bottlers who sell drinks to stores. People buy Coca-Cola every day. The brand is one of the most valuable in the world. 2 sentences. Easy. Now, try explaining a biotech company that's developing a new cancer drug. How does it make money? Well, it needs FDA approval. Then it needs insurance coverage. Then it needs doctors to prescribe it. Then it needs to beat competitors. That's already more than 2 sentences. And most people still don't understand the risks. Buffett would say stay away from that biotech stock, not because it's bad, but because it's outside your circle. The lesson is not that diversification is bad. The lesson is that owning 50 random stocks you know nothing about is worse than owning 5 great stocks you understand deeply. Peter Lynch, another famous investor, said it this way: buy what you know. If you shop at Home Depot, understand why it's better than Lowe's. Then consider owning it. If you use Apple products and love them, and you understand why customers are loyal, then consider owning it. But don't buy a stock just because someone on TV said it's going up. That's mistake number 4, the silent wealth killer that almost everyone ignores. Mistake number 5, ignoring fees and taxes. This is the silent wealth killer. Small leaks sink big ships. Buffett proved this with a famous $1 million bet in 2008. He bet that a simple Lacoste index fund would beat any hedge fund over 10 years. He won. Let me explain what a hedge fund is. Hedge funds are investment funds for rich people. They charge very high fees, usually 2% of your money every year, plus 20% of any profits. Sounds expensive, right? But people pay it because they think hedge fund managers are geniuses. Who can beat the market? Buffett said they can't. He bet $1 million that the S&P 500 index fund, which charges almost nothing, would beat a basket of hedge funds over 10 years. The results? The index fund returned over 125%. The hedge funds returned just 36%. That tiny difference cost the hedge fund investors millions. Let me make this real for you. Imagine you invest $10,000. You earn 7% per year for 30 years. With no fees, you end up with about $76,000. But if you pay just 1% in fees every year, you end up with only $57,000. That 1% fee ate almost $20,000. That's 28% of your total returns. Gone. Now imagine you're paying 2%. That's what many actively managed mutual funds charge. With 2% fees, your $10,000 grows to only $40,000 after 30 years. You lost almost half your money to fees. And fees are just the beginning. Taxes can be even worse if you're constantly buying and selling. Every time you sell a stock for a profit, you pay capital gains tax. That tax could be 15 to 20% of your profit. If you trade frequently, you're giving a huge chunk of your returns to the government. Buffett's advice is simple. For most people, the best investment is a low-cost S&P 500 index fund. Buy it. Hold it for decades. Don't trade. Don't try to beat the market. Just own the market. In fact, in his 2013 shareholder letter, Buffett wrote that after he dies, the money he leaves for his wife will be invested in a simple index fund. Let me read you his exact words. Not my advice to the trustee could not be more simple. Put 10% of the cash in short-term government bonds and 90% in a very low-cost S&P 500 index fund. That's from Warren Buffett. If the greatest investor in history recommends index funds for his own family, that's worth paying attention to. Here's another way to think about fees. Imagine you're driving a car with a small hole in the gas tank, but every time you fill up, some gas leaks out. You might not notice it at first, but you're spending hundreds of extra dollars on gas. Fees are the same. They leak out of your returns every year. Silently, by the time you retire, that leak could cost you hundreds of thousands of dollars. So, check your fees. If you're paying more than 0.5% in annual fees, switch to a low-cost index fund. Vanguard, Fidelity, and Schwab all offer index funds with fees as low as 0.03%. That's $3 per year for every $10,000 invested. Almost nothing. That's mistake number 5. Now, let's talk about a mistake that confuses almost every new investor. Mistake number 6 is thinking a cheap stock is automatically a good deal. This is one of the most common mistakes new investors make. They see a stock drop from $100 to $10, and they think, wow, it's on sale. I should buy. But here's what Buffett learned from his mentor, Benjamin Graham. Price is what you pay. Value is what you get. Those are two very different things. Dollars can be expensive if the company's going bankrupt. Stock at $300 can be cheap if the business grows for decades. Let me give you a real example. In 2018, a company called GE, General Electric, was in trouble. The stock had dropped from $60 to $10. Many investors thought GE is a famous company. It's been around for over 100 years. At $10, it's a bargain, so they bought, but they didn't look at the value. GE had huge debt. Its businesses were failing. Its leadership was weak. Over the next 2 years, the stock dropped to $6, then $4. Today, it's still below $10. Those investors lost money. Now compare that to Buffett buying Coca-Cola in 1988. At the time, Coca-Cola stock looked expensive compared to other soda companies, but Buffett didn't care about the price. He cared about the value. He saw that Coca-Cola had a brand that spanned the entire globe. He saw that every day over 1 billion drinks were sold. He saw that Coca-Cola had pricing power. It could raise prices a little every year, and people would still buy. He saw that Coca-Cola had loyal customers who preferred it over any other soda. He saw that Coca-Cola had a moat, a competitive advantage that competitors couldn't cross. Since 1988, Buffett has made over $20 billion from that single investment. The price he paid was almost irrelevant. The value was what mattered. Buffett calls this margin of safety. In a 1996 annual meeting, he used a bridge analogy. He said, "Don't drive a 9,800-pound truck over a bridge that says capacity 10,000 pounds. Find a bridge that says capacity 15,000 pounds. In other words, don't buy a stock that's fairly priced. Wait until it is significantly undervalued. Give yourself a cushion, a margin of safety." Let me give you a simple way to think about value. Imagine two houses. House costs $100,000, but it needs a new roof, new plumbing, new electrical, and it's in a bad neighborhood. House B costs $300,000, but it's in perfect condition, in a great neighborhood with good schools. Which is the better deal? House B, even though it costs more, because you're getting more value. Stocks are the same. Before you buy any stock, ask yourself this question. If the stock market closed for 5 years and I couldn't sell, would I still be happy owning this business? If the answer is no, don't buy it. Because when you buy a stock, you're not buying a ticker symbol. You're buying a piece of a real business that sells real products to real customers. If you wouldn't want to own the whole business for 5 years, don't own it for 5 minutes. That's mistake number 6. Now, the biggest mistake of all. Mistake number 7. The biggest one of all. Letting your emotions drive your investment decisions. Buffett said, "Something I want you to remember forever. The most important quality for an investor is temperament, not intellect. You can be the smartest person in the world. You can have a PhD from MIT, but if you panic when the market drops and get greedy when the market rises, you will lose money." Here's what most people don't understand. The stock market is designed to test your emotions. It will go up. It will go down. It will crash when things look worst. It will soar when things look best. Let me tell you about the crash of 2008. The market dropped over 50% from its peak. Banks were failing. Companies were going bankrupt. People thought the entire financial system might collapse. News anchors were saying things like, "This is the end of capitalism as we know it." What did most investors do? They panicked. They sold everything. They said, "I'll get back in when things are safe." But by the time things looked safe, the market had already recovered most of its losses. They sold at the bottom and bought back at higher prices. They lost money twice. What did Buffett do? He watched the news. He saw the crashes, and he did nothing. Or sometimes, he bought more. In October 2008, at the very worst moment, Buffett wrote that op-ed in the New York Times. He said, "I've been buying American stocks. If prices keep looking attractive, I will put more money in," he said. In the short term, the market is a voting machine, but in the long term, it's a weighing machine. Meaning, in the short term, fear and greed drive prices, but the true value of businesses wins. And Buffett was right. From the bottom in 2009, the market went up over 400% over the next 10 years. The people who panicked and sold missed almost all of it. The people who stayed calm and held got rich. At the 2025 annual meeting, his final one as CEO, Buffett reflected on 60 years of investing. He said his biggest mistakes weren't the things he bought that went down. They were the things he didn't buy that went up. He called these errors of omission. Why did he miss those opportunities? Because he let his emotions get in the way. Too cautious, too afraid to pull the trigger, he said. "I've made many mistakes, but the costliest ones were the ones where I knew what to do and didn't do it because I was scared." So how do you fix this? Here's a Buffett hack. Before you buy any stock, Write down your investment thesis on paper. Why are you buying? What price would make you sell? What would have to change about the business for you to change your mind? Then, if the stock drops 30% in 6 months, you can look back at that paper. If nothing fundamental has changed, don't sell. Buy more if you can. That's how you remove emotion from investing. You make the decision once on paper when your mind is clear. Then you stick to it. Let me give you an example. In 2020, Buffett bought $5 billion worth of airline stocks. Then the pandemic got worse, and he realized he made a mistake. He sold them at a loss. He didn't hold because of ego. He didn't hold because he hoped they would come back. He looked at the facts, realized the business had changed, and sold. That's not emotional. That's rational. The key is to have a plan before you need it. Write it down, then follow it. Bonus section. Let me show you what Buffett is doing with his own money right now. According to Berkshire Hathaway's most recent SEC filing, here's what he owns. The largest holding is Apple, about 45% of the entire portfolio. That's over $120 billion in one stock. Second is Bank of America, about 13%. Third is American Express, about 10%. Fourth is Coca-Cola, about 8%. Fifth is Chevron, about 6%. Those 5 stocks make up over 80% of the portfolio. That's concentration. Now here's something interesting. In the last year, Buffett has been selling some Apple. He sold about 10 million shares. He also sold most of his Amazon position, cutting it by over 77%. And he sold some of his Paramount stock. What is he buying? He bought a new position in the New York Times, about 5 million shares. He added to his oil stocks, Chevron and Occidental Petroleum, and he added to his insurance stocks. What does this tell us? Buffett is moving away from tech and into energy and media. He sees value in traditional businesses with steady cash flows. He's also sitting on a huge pile of cash, over $30 billion. He's waiting for the next crisis to buy. That's what Buffett does. He waits. He's patient. He buys when others are fearful. That's why he's worth over $140 billion.